We detected an unusual trade worth $48 million on 3M stock, ticker symbol MMM. But here's what makes this even more interesting. 3M reports earnings in less than a month on July 22nd. And so in this video, we'll break down this unusual options activity to find out whether this wealthy investor is going bullish and buying, expecting the stock to move higher, or bearish and selling, expecting it to drop lower. Because as we all know, the rich have more access to exclusive research and information, sometimes even leaked insider information, including potential access to earnings data before it's public, giving them an edge to make better, smarter financial decisions. This is how smart money always stays one step ahead, well before the rest of the market catches on. No wonder the rich get richer. Now, as we can see here on the chart, the stock is trading near its 52-week high. So the big question is, will it break out to a new high or drop back down? According to technical analysis, this price level could act as resistance again, rejecting the price down lower just like it has in the past multiple times. So yeah, technical analysis can be confusing, and that's why it helps to look at what smart money is doing. And so to level the playing field, let's dive into the unusual options activity to gain insights from the rich so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, the most unusual trades happened on June 27 at 11:11 at the 19-second mark for these September 19 options at the 140 strike calls and the 125 strike calls. Now, we need to be very careful with these 125 strike call options because when we dive deeper into the option chain for the September 19 options, we can see something very interesting. At the 125 strike calls, there is 23,420 open contracts, slightly more than the 23,298 contracts that were traded at the volume. So that tells us this wealthy investor closed their position here and rolled to a higher strike price to the 140 strike calls, and we can see that the number of open contracts is 391, which is much less than the volume being traded. So we know these were the new opening trades, and that is why we also rolled into the same position here, marked as POS, which stands for our position, and the green color indicates a buy position. Now, you might be wondering, why are we rolling our position? Well, the short answer is, this is a risk management strategy, just like many wealthy investors, to lock in profits and reduce risk. You see, we've been tracking this wealthy investor since April 24th, when this unusual trade was opened in the September 19 options at the 125 strike calls. As you can see here, that's when those 23,000 contracts were opened, causing a noticeable spike in volume. Now take a look at the price of those options back then on April 24th, 1880. And if we fast forward to today on the options time and sales tape, you can see they were recently closed at 29.15, clearly more than before. So that's a profitable trade. So how much profit exactly? Well, we can calculate that by taking the options closing price of 29.15. Keep in mind that options are priced per share, and each options contract controls 100 shares of stock. So we either multiply by 100 or simply move the decimal 2 places to the right. That means the dollar price of each contract is $2,915. And so we subtract this by the initial cost of entry that we saw earlier, $1,880 or $1,880, and we get a profit of $1,035 per contract. Now we divide this profit by the initial cost of $1,880 and multiply by 100 to express it as a percentage, which equals a return of 55% profit, all because we tracked and followed this wealthy investor's trade. And so if you want to get more of these insights from smart money, that have a higher profit potential, then go to our website. We'll put a link up here. Keep in mind that our members also get earlier access to trades like this before anyone else, even before we share it with the public. So if you're tired of being late and want more time to act on these opportunities, just head over to our website where you can see in real time when and which stocks wealthy investors are trading on Wall Street so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? Now let's take a look at the new trade. As we mentioned earlier, this wealthy investor closed out of these 125 strike calls to lock in profits and then rolled the gains into a new trade at a higher strike price. This means that these 140 strike calls are the new open trades. And so we can calculate the cost of this new trade by multiplying the price per contract by the total number of contracts, which is 14,250 plus 14,250, which is a total of 28,500 contracts. And so when we multiply this by the price of $16.89, this equals a total trade cost of approximately $48 million for this new trade. But keep in mind, just because a trade is large does not necessarily mean it has a high chance of success. In fact, this one carries more risk than the smaller, more selective trades we share on our website. With that said, even though this trade carries higher risk, we still took it, but we used position sizing to manage our risk. Based on our deep research across multiple variables and data sets, this wealthy investor bought these September 19 options at the 140 strike calls for $16.89 each, the same price as we calculated and saw on the options time and sales tape. And so when we analyze this trade, you can see here on the risk profile graph where the profit or loss shows up here and the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line over here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below this zero break-even line, as the share price goes down, this trade becomes more negative loss. And as the share price goes up, this trade becomes more positive, more profitable, because it's going long bullish on 3M stock. We can also confirm that by checking the options Greeks. This trade has a positive delta, which means it's positioned long and bullish. If it was a short bearish trade, we would see a negative delta instead. But keep in mind the risk with this trade. It has a negative theta, which means it loses value over time due to time decay. And that is why you can see here the purple line drops down lower to the blue line as we approach the option's expiration date. Since these options lose value through time, the break-even on this trade moves higher as time goes on. And so you can see here, even though the call options we bought have a strike price of $140, the stock needs to trade above $156 per share for this trade to be profitable at expiration. Because of this added risk, along with other factors, we only took a small position in this trade. We don't invest a lot of capital into these higher risk trades. Instead, we focus most of our capital on lower risk, higher probability of profit trades, the kind of trades we share on our website. We'll put a link to our website here, where you can also learn more strategies to increase your profits. Let us know in the comments. Do you think 3M stock will break out and make a new high, or drop lower? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.